Good afternoon, everyone. Let's make sure we are on the right mic. How are we all doing? Hope you are well. Finance Friday. It's 2 weeks since we've done the last one. It's gone quick, but we are here now and ready to get going. So we'll just wait. I can see a few of you coming in now. Good afternoon. How are we doing? Just give us a yes, give us a hi in the chat box so I can see you. How are we all doing? I'm just saying, it seemed only yesterday we were doing the interview with Kerry. Narain, good to see you. Hi, John. Give us a like, give us a thumbs up, and we'll get started in a second. I can see them all coming in now. Anthony, Ro, good to see you guys. Alex, yo, good to see you, mate. How are you? Are you good? Hello there. I don't know who you are, Facebook user, but it's good to see you anyway. All right, so we're going to do a little bit like not last time with Kerry, but a little bit like the previous time. So we're going to do Q&A. So if you guys have got any questions that you want to ask, we will hit that part of the session later on. But what I'm also had is I've had a load of questions come in from people, which is great. So I've got about 7 or 8 questions that I want to go through, which is good. So David, good afternoon. Good to see you. So yeah, so we'll cover those and cover the questions, but I wanted to spend a little bit of time on the 20K week. Now, let's get straight into this. I think it's a really important subject. So did any of you see the title and think, oh, I want to find out about that? So did anyone think 20K in a week? I want to find out what he did. So be honest with me. Did anybody here think, 20K, I want to know what he did? How did that happen? Yeah, but this is the important lesson for this. So really, me writing the 20K in the post and on the email was more about getting you guys to turn up, because when money's talked about, what tends to happen? Which emotion starts to get going? Sparks people's interest. What emotion stimulates that? Or what feeling stimulates that? It's greed, isn't it? You got it. And there's nothing wrong with greed. Having some greed in trading is important. Being a little bit greedy, wanting to make money, wanting to get a return, taking a risk to get a return is good. However, you've got to make sure that it's balanced. But the most important lesson I think that you can take away from today is it's not about the 20K. It's not about the 320% on the crypto trade. And it's not about the 12% that month on my oil trade. It's more about the percentages than it is about anything else. Does that make sense? So it's more about the percentages than the money, but it's actually, the lesson isn't even about the percentages, because could anyone go along and risk 50% of their account to make, well, you can't risk 50% on a CFD or a spread bank account, but could people come along and risk, say, 30% of their account to make 12% and then brag about making 12%? Could somebody risk 50K to make 20K and brag about making 20K? Of course they could. So seeing the words my 20K week doesn't actually mean a lot. What's actually important in this situation is, how did you make it? Give me a yes or a thumbs up, guys, if that's making sense. So it's not the 50K. It's not the 12%. It's what did you risk to make it? So that's the first thing to take away from this. That's the key thing to take away in terms of the lesson, is that very simply, all I was doing was risking the same amount than I would risk on my normal trade. Good. So Lee likes that. Good. So think about it like this. If I risk 2% and I make 12%, have I got a good return on my money? Absolutely. It's a great return, isn't it? So if I risk 2% to make 12%. So that's all that happened. So the key thing to understand is that if you know the strategy and you stick to the plan on that strategy, that same 12% is available to you. And that's the key thing to remember is this. The same 12% is available to you, me, Lorraine, Raul, Lee, Philip, you guys. It's all available to you if you know the right strategy and you stick to the rules. Will I always make 12% on that particular trade every single month? No, I won't. It won't always do that. Will some months, hopefully, it make more than that? Yes. So the important thing to understand and the important takeaway from this is that it's more about percentages than money. And then secondly, it's about the strategy that you trade and what did you risk to make that. And then thirdly, if we go and have a little look at oil, it's about the process that you went through. So this particular strategy is something that in the trading room, we have been optimizing for the last couple of years. So it's our monthly beat the bank strategy that a lot of people within the TSC community trade. But within our trading room, we've also been optimizing the strategy. So if I just pull up the oil chart here and I'll just make sure you can see it. Just give me a yes if you can see me and my screen. There we go. So you can see oil's been in a lovely uptrend pretty much for the last couple of months. So you can see had a lovely uptrend. You can see there, prices come up, been up, series of higher highs, higher lows. So we've been fortunate enough for that particular market to be an uptrend. Now, our Feb strategy triggered long, and as you can see, had a big move up, big move up. Now, previously, this is important, previously, until we optimized the strategy, you would be getting out at the equivalent of what is known as a 2-to-1, which is where you get out essentially once you've doubled your initial stake. Initial stake being 2%, so you would get out of your trade when the trade did a 2-to-1 and you were in 4% profit. So the difference here is, can everybody see? Just give me a yes in the box if you can see that the market after the 2% area, which was essentially about there, 2-to-1 there, 3, the market continued up, continued up, continued up. Now, just because the market continues up, we didn't decide, and this is important, we didn't decide, it's going up. I know what we'll do this month. We'll just hang on. Because this is something I see a lot of traders do, is they're in a trade, they had a predetermined target, and then they think, the market's going up. Well, of course it's going up at the time you get out, or if it's a short trade, of course it's going down at the time you get out. That's happening. But what we don't do is go, I reckon it's going to go higher. So we just hold on to it. And this is something, again, this is another lesson from this that's really important, is what we did is we went away and collected the data on the probability of running these trades for longer than the standard 2-to-1. All right. Give me a yes if that makes sense as well. Those of you that are here, give me a yes if that makes sense. So it wasn't just a case of, it all looks good, it's going up, we'll run it for longer. What we actually did is say, well, hang on a minute. We want to be able to see if what we've seen on some trades works on multiple trades. So what we actually decided to do was say, right, okay, let's test it. Let's test it over 16 years. Let's make sure the data fits. And then as a result of that, we traded it. So yeah, this month was good. So again, it's important to understand that what we made was a 12% win, which was essentially with a 2% risk, we managed to get a 6-to-1 on the trade. Now you'll actually notice that we got stopped out and price has actually gone higher. So the price has gone higher. But again, we don't know that. We don't know what's going to happen. And I see this too much with traders, is they will sit there and they will say, price is going to go up, price is going to go down. Nobody knows what is going to happen going forward. So all you've got is the data from the past. And that is what we at Trader Support Club are world class at, is the amount of data and the level of data that we have. So what a lot of people will do is they will come in and say, okay, I've seen it do this once, so the next time I trade it, I'll try and run it for longer. Yet the conditions don't necessarily work. Whereas when you've got 16 years worth of data behind you, what that means is you will be more confident, even if for a couple of trades, running the strategy doesn't actually work and you don't benefit over the short term. So yeah, we've had a couple of nice winning trades on oil, and especially this month. So that wasn't all of it though. That wasn't all of it. And again, I want you to make a note of this. Timing has a lot to do with trading. I don't look to make 20K a week. If I do, great. But I don't look to make it every single week. All right. I don't look to make a sum of money. Sometimes it's just timing. Trades, different positions come in at once. But this was also a nice week because I was in a longer term position on the hot topic of the moment. Can anyone tell me what the hot topic is at the moment? What's the hot topic when it comes to trading and investing? What's the hot topic at the moment? Anyone want to guess? Yeah, Bitcoin or cryptos, isn't it? Specifically Bitcoin. Yeah. So I want to teach you a little something about, well, I say a little something I could spend probably 2 hours going through, but I want to give you a couple of little bits on what I've been doing. So how many of you understand the difference between trading and investing? I've covered this on free workshops that I've done before. Who understands the difference between trading and investing? Essentially, it's different in two ways. One's short term, one's long term relative to the other. And then on top of that, what you have is one is basically ownership and one is trading a contract. So for me, back when we saw Bitcoin come back down, settle down. So I managed to trade, I traded Bitcoin and actually purchased it and bought and sold it through this process. Didn't really know a lot about cryptos, had a basic understanding of the blockchain, looked at it and said, right, I want to experience this and experiment on it and see how it works. And I can remember getting out around this point here. I got in and around here and got out here. And I remember it took 3 days to get out of my trade. 3 days, because back then the crypto exchanges were slow, to say the least. Anyway, so for me, once I started to see it bottom out and come back up, I was like, okay, I'm going to do some more research. So what I've done, and this is really important, I'm not making any recommendations on what you guys do, but for me, I treat something like Bitcoin no different than I would treat any form of share ownership or long-term investment. So I did the research and decided to actually physically buy Bitcoin and Ethereum and actually own it in a wallet because I believed in the process long-term. Give me a yes if that makes sense. And it's not so much Bitcoin and Ethereum, it's more the idea of cryptocurrencies and the blockchain. So I actually bought a batch around this level here, slightly higher, around this area here. I bought a small batch of 3 different cryptocurrencies. And relative to my overall investment portfolio, it was pretty small because, again, still didn't really know where it would go, basically had a longer term view. And then what happened was we came out and then went higher, bought a little bit more, not a huge amount. And then around this level here, I decided to do something else, not through my standard trading accounts, but through something called Revolut. I actually bought positions in the same 2, Bitcoin and Ethereum, or 2 out of the 3. So then what I was doing was taking a slightly higher percentage than I would risk in my trading account. So for example, if I had 10,000 in my trading account, the max I would risk on that is 2. Doesn't matter if it's 10,000, 100,000, whatever amount I've got, I'm only going to risk 2% maximum, on some strategies 1%. But with this, I took a small sum of cash relative to what I trade and I risked a little bit more. But the important thing here was it was a very speculative trade. Give me a yes if that makes sense. So essentially, this was money that I could afford to lose. So it's very speculative, different in the way that I traded it. So then what I did was I got in around August time. You can't see it too well on this chart. I might have to go down to a lower time frame, just a higher time frame actually. No, lower time frame. There we go. Yeah, so you can see it a lot better here. So I got in August. Here. So I got in August when we broke those highs. And then I got in again just here. So I was a little bit fortunate as well. It was just after the breakout. So I'm just trying to get a pen so you can see. So I got in here. That was the last point I got in. And then I got in August when we broke out of that little sideways move. Yes, we had a little high here. So for me, I plan to be in this, what I would call longer term trade. I plan to be in this until we reached 50,000. If we didn't reach 50,000, that was fine because I was going to cover it and I had essentially a stop. With that account, you can't have a stop the way you do when you trade here. But essentially what I was doing was saying, right, I'm going to, if we break these lows, I'm going to bail out of that, but I'm going to run it up. And if we get it the way I want, I'm going to get to 50,000. Now, have a guess what I was predicting in my mind in terms of time for how long it would take to get to 50, for Bitcoin to get to $50,000. Have a guess. Anyone want to have a guess? In terms of time, and there's a lesson in this. I was looking around, if it remains positive, I was looking for 2 to 3 years. Yeah. And then we basically do it in the best part. And that was 2 to 3 years from this point, from 20,000. We basically do it in a couple of months. So the lesson there is nobody knows where price is going to go and nobody knows how long it's going to take. So yeah, we did it very quickly. So I got out slightly, I got out of 52. So I got out of 52 out of that position. So in terms of percentage return, relative size in terms of money, it only made up probably about a quarter, just under a quarter of the 20K, because it was a much smaller amount of money in relative terms. But in percentage terms, it was a big return. So in percentage return, it was a big return on the money. So yeah, I'm out. Now, I've only sold half of that position. Okay, so I've only sold half. Let me be clear. I haven't sold all of that. I've sold half. The other half, have a guess what I'm looking to run that to. Have a guess. Give me a figure. See if you guys can have a clue. So I've got out a half at 50. Have a guess where you think I'm going to try and run the other half to. I can show you the order. So you might be able to see it on the screen if I just do this. So you can see there, you can see the little red dots right at the top. That's where I've got out half the position. But I've still got 2 positions running right there. So I've still got 2 positions running. Yeah, I'm going to go for 100 on that. But do I know it's going to hit that? I have no idea whether it's going to hit that. I have a long-term view on cryptocurrencies, but I have no idea if it's going to hit that. Give me a yes if you're all following. Because the trouble is, people hear stuff like that and think, right, they must know something that I don't. They must this. Ultimately, with this particular setup, do I have tons of data to back up what I'm doing here? Do I have tons of data to back up what I'm doing? The answer is no, I don't, because this is completely new territory. I don't have years and years of trading records on 5-minute charts, 60-minute charts. So for want of a better word, you could argue that what I'm doing here is actually a punt. Over here is an investment, but I'm basing that on research and I'm doing that based on that. But this is very different to what I was doing with the oil trade. The oil trade's got 20 years worth of tested trades and nearly 4 years worth of live data behind it. So it's important to understand that the two were very different. So you could argue there was a little bit of luck in terms of the timing, that we had a 12% winner on oil the same week that Bitcoin came up and hit the 50% mark. And it's important to understand from the long-term perspective that trading can actually be a lot like that. where what you get is you get good times, not so good times, really good times, not so good times, flat times, okay times. Your equity curve in trading doesn't go like that. It doesn't look like a Bitcoin chart all the time. You get periods where that's happening, but not all the time. All right. So just a couple of lessons. Give me a like if that was useful. Give me a yes. Just a couple of lessons on what has happened the last couple of weeks. Good. So we'll come to questions. So we've got a load of questions that I want to go through, and then I'll come to your questions before we finish. I wouldn't be surprised if I get a couple of crypto questions when we go through this. So let's go back. Right. So first question. This is from James. And he asked this. Really good question. I know that we asked Kerry the last time, but what was your motivation to get into trading? So that's a really, really good question. Honestly, my motivation to get into trading was quite negative when I started out. And the reason why is I'd actually had a very successful first business, but my second business didn't do so well. And we essentially went to the wall. We didn't go bankrupt. We didn't go away owing lots of people money, but the process that we were putting in place didn't work. So we were trying to build this gadget that would work in the health and fitness industry. And at the time, I was in quite a bit of debt. My business partner had remortgaged his house. And at that point, he decided he didn't want to go any further. And at the time, and I remember Narain will probably know this story, at the time, I was pretty angry and frustrated because I wanted to carry on with this business. And for me, it was like, okay, I'm beholden to my business partner's decision. Now, with the benefit of hindsight, which you never have at the time, I can look back and it was probably the wise decision to call it quits at that point because some big guys came in and essentially did what we were doing, but did it a lot better. But at the time, I was like, right, I want to do something and be involved in something that doesn't have any reliance on anybody else. Can any of you guys listening relate to that? So at the time, I was like, I don't want to go into business where I am dictated to, or not dictated to, but I have to basically get agreement with a business partner. So it was actually what drove me to start trading was actually more pain motivation than I would say positive motivation. And at the time, I happened to be part of an investment club. And within that investment club, we used to meet, it was down in Reading. We used to meet once a month and between 20 of us try and decide what shares we were going to buy. And basically, we spend 3 hours deciding what shares we were going to buy. And then basically, probably once a month, we probably place one position. So I found it a bit slow. I like the idea of being in the investment club, but one of the guys there was actually a trader. He was a part-time trader and he was going through the process of going full-time. So I spent a little bit of time with him and then I wanted to learn more about options. So I went out to Las Vegas at the time and went on a training course out there. First training course, if you add in the cost of flights and everything like that, was probably in the region of about $3.5–4 grand. And that was a basic course on options because back then you didn't have the advantage of the internet, or you did, but it was dial up. So it was very much, if you wanted to learn, you went out and you did live events. So it makes 197 for our kickstart for 28 days seem like a steal. So yeah, it was a basics option course. So I started out trading what's called covered calls and put and call options. Don't trade those anymore because spread betting came along and leverage trading through CFDs came along. And that's what I ended up then focusing on because it became much easier. Because with options, you've got to be able to get chart direction right, but also timing right. But with spread betting and CFD trades, it's more about the timing. So that's how I got into it. So my kind of motivation was to be doing something myself that was purely reliant on my own performance. Cool. Next question from Stuart. What's the best way to manage risk when you're on a losing streak? So what's the best way to manage risk when you're on a losing streak? Great question. I'm going to get the chart up again because I think this will be useful. We can look at this in a little bit more detail. So the challenge is there's a couple of points here that need to be looked at. And the first one is when you're on a losing streak is you have to be clear and define what a losing streak is. Because some traders you'll speak to will say, I'm on a losing streak. And you say, well, how many losers you had? And they'll say, I've only had 2. So in their head, 2 losing trades is a losing streak. You'll speak to some traders and they're 12 deep and they don't know what they're doing wrong and they're all over the place. And that's enough for them to admit they're on a losing streak. Some traders can be winning and losing, but they say a losing streak and they're referencing it in terms of profit and loss, not winning or losing trades. So it's very important that you define what a losing streak is. So directly to answer your question, how do you manage risk? Well, as far as I'm concerned, I manage my risk the same way when I'm winning or when I'm losing. So I don't suddenly risk more after 3 losing trades to try and win it back. So I don't do martingale or any of these weird and wonderful things where you increase your risk and then eventually the trade goes your way, because the time you choose to do that is the time the trade doesn't go your way and you hit the black swan or the anomaly and it doesn't work. So for me, I will do my risk, my percentage risk per trade stays the same. Obviously, as my account decreases, if I'm on a losing streak, then that 1% or that 2% is less each time. So even though I'm risking 1%, it is actually a smaller amount of money. It's always relative to the size of the account. So me personally, I won't do anything. Now, what's really important on our Kickstart training, what we do is we show you which data sets you need to record, because the challenge is a lot of people who do record data, they're recording the wrong data. So if you're recording the right data and you have enough data, and this is key. So with our swing trading, we have the best part of probably, I would say, getting on for 10 years worth of backtesting data on nearly all our strategies and nearly 8 years of live data. And that's on a combination of 6 strategies, and each trade will probably have 15 data points. So that's a huge amount of data. Now, if you have a really good data set relative to the time that you're going to trade, then there are other options. I've worked with a couple of guys in our trading room where what we've done is we've looked at losing runs and winning runs. We've looked at both losing runs and winning runs, and we've established when those losing runs reach an extreme. So it might be a period of 5 winning trades on the trot. It might be a period of 4 losing trades on the trot. And then what we've got those traders to do is very slightly, not double up, so not be risking 1%, 1%, 1%, 1%, and then on the 5th trade risk 2%. But what we've got is we've got a risk parameter window, we call it. And what we then do is say, well, hang on a minute, after a certain number of trades, you know you're reaching a higher probability of the next trade winning. So you might go from risking 1% to 1.2. Now, the risk is you could still have losers, but you're working in a framework of, say, 0.75 all the way up to 1.25. So you're already within a predetermined risk per trade. So there isn't a best way to do it. I think if you're looking at it from a simplistic point of view, the best thing you can do is keep sticking to what it is you're doing. And only do something like this if you have enough data to back it up. All right. So now I've got 3 questions here from Simon. So Simon sent these in. So I'm going to answer, I've written them down as 3 questions. I'm going to answer them individually because there's some good questions here. So in your trading career, how many years did you day trade versus swing trade? Well, basically for the first 12 years, and the first 2 to 3 of those weren't very good. So I would say if you include those, they were still day trading. So the first 2 to 3 years weren't great. And then within that period around the 3-year mark, then it started to take off. So yeah, about a total of 12 years was pure day trading. So 12 years was pure day trading. And then I would say those last 2 years, there was a crossover. Now I only swing trade. So I don't day trade anymore. I often get asked, do you miss it? A little bit. I'm missing it at the moment because Kerry's working on a couple of new strategies. There's a little bit of greed there. So there's a little bit of me that's missing it because she's working on some new strategies. She mentioned that on the last Finance Friday, and they're going very well. So there's a little bit of me like, oh, I quite like the idea of that. But for me, if I look at it over the bigger picture, for me, I prefer the swing trading element, which I've been doing, I would say, for about the last 8 years. So there was a period where I was doing both, but that was when Trader Support Club was a lot smaller and I had more time. And there was a bit more of a push for me to do it, which leads on to your next question, Simon, which is which made the most impact, or which made the most impact and increased to your trade, which made the most increase to your trading account is basically what you're asking. Answer is day trading. So in terms of equity curve, day trading all day long. And there was a period, if you around the sort of 2006 through to 2008, where you were getting such good runs on the major currencies across the 5-minute charts that you were having, it wasn't really many weeks that went past where I didn't hit good numbers. I'd have the odd bad week and even the odd bad month, but yeah. So in terms of equity curve, then it would be day trading all day long. But that was relative to time. So one of the things, and a good lesson for everybody, is it's not always about the return, it's the return on your time invested. So our best strategy for your return on time is not actually the best performing strategy. Guys who are listening, who are here, give me a yes if that makes sense. So the strategy that gives you the best return for the time you put in is not the best for the overall return. So we have a strategy that averages 20% a year, but you only have to put in 10 to 15 minutes a month, and compound it up. That can be 800% over a 10-year period, but you're only putting in 10 minutes a month. So actually, in terms of your return on time invested, that's actually the best performing strategy. But it isn't the best performing in terms of return. To give you an idea, Kerry, over a 2 or 3 week period on one of her new strategies that she's running, is up in the high 70, 80% return. So that's in less than a month, but relative to time, she's probably in front of her screens for 6 hours to do that. So there is an element of time. So it's really important for all of you listening, if you're thinking about, well, what is it I want to achieve? Everybody wants more money. And I said this on the free workshop this week. Everybody wants to make more money, but what is it you want to achieve, and what time can you give relative to that? So yeah, I'll get Kerry on again at some point. Yeah, so she's but she also understands that the result that she's achieved over that short period of time is not in line with the overall result. So she said, I'm probably going to hit a little bit of a losing streak. And that's the power of having the data. And that's also the power of having data when you're thinking about what you want to achieve. Because if there's data to suggest a specific figure, so if you want 50% a year, and there's data on 2 strategies and they average 80% a year, then that strategy could be legit for you, because it will give you potentially the return, and you can actually underperform the strategy. So that's the idea there. So absolutely, for me, it was day trading. So yeah, my returns, if you're just judging it by pure returns, it was day trading over swing. But if you look at it versus time, I would say I'm probably there or thereabouts with my swing trading in relative to time that I put in. And then Simon's last question was, and you should be able to see this, can we hear a little bit about your day trading days, markets, times you traded? Yes. So I used to trade quite early. So I would look at a certain window. I would look in front of my screens around 7:30, because the currency markets would be opening around 7 UK time. And I would usually trade up until probably about 10. And I would make the point of having something like a personal training session or something that I had to get out of the house of around 12, because I had a tendency of sticking in front of my screens. Now, initially, Simon, I made the mistake of trying to scalp for long periods of time. And I say long period of time through to like 10 o'clock. And what I realized from a scalping point of view, it was just too long. So I started trading less, so reduced my trade frequency. And essentially, I would trade, at that point, I would trade probably four majors. If I think back, euro, pound, yen, wouldn't necessarily trade Aussie, look at US dollar CAD. I'd be more inclined to focus on US dollar CAD going into the afternoon. So what I would do is I would definitely trade the morning. And then if I saw things setting up or potential into the afternoon, and then could see news announcements that might shift the market or get the market going, I wouldn't trade the news. Then I would be more inclined to trade the afternoon. But for me, what I ended up doing initially was trading the whole day. And I realized, for me personally, my attention span is not great in terms of sitting there for the entire day. So I would prioritize the morning, and everything I tested was around the morning and afternoon, but I'd prioritize the morning. And then if the afternoon there was potential there, then sometimes I would come in. And often it would be because I maybe hadn't had many trades in the morning. So yeah. So it fluctuated from, I'd probably say it probably averaged out at 1 day or 1 day, maybe 2 days out of the week that I would be there for more than just 7:30 to 11. But I'd always break around that midday period. Sometimes I'd miss trades, but I'd be fine with that. So I would just factor that in. So that was the times I was trading. I was trading a 5-minute, basically I was trading 5-minute pullbacks. So what I was doing was trading 5-minute pullbacks, and I was using a 60-minute chart as my filter. So what I would require is what we've talked about in the trading room, which is I would need 60-minute momentum. So I'd need moving average momentum to be corresponding with the particular pullback that I was seeing. So unless I could see moving average momentum relative to the price on the 60-minute, I wouldn't trade the pullbacks on the 5. And that was it. It was all I traded was with the trend on day. I tried trading against the trend. It didn't work out for me, which is interesting. So I trade against the trend on now, do primarily most of my swing trading against the trend, but I didn't do that when I was day trading. So if you put in comments in, I will come back to you. So what we got here. So your outcomes are based on time available. Partly, Barry, yeah. So some people come to me and say they want to make, they want to make 20% a month. I'm like, how much time have you got? I've got an hour a day. Well, it's not going to work, or it's very unlikely. You're going to have to over leverage to be able to do it. So this is where working with us is really useful, because we've got myself on swing, Kerry on day, Martin on day. And you can, if you've got time, do a combination of the two. You can hyper focus on one or the other, and then you can get a realistic outcome. If somebody said to me, I've got an hour a week, I've got an hour a week, then I'd probably say, well, you want to be focusing on trading our monthly strategy, our beat the bank strategy, because then you only have to put in a couple of, basically less than an hour a month at a certain point. And in terms of return for time, it's better. So it's a little bit about being realistic. And you're going to find that on the kickstart, once you get to the end of week 4, is you'll have a plan relative to time. So then what that does is that creates a balanced expectation going forward, because often traders will get skewed because their expectation is out. All right. So I'll come to questions from you guys in a second. All right. So let's just see what Simon said here as well. Yeah. So strategies, as I said, purely pullbacks with the trend. That's all I traded. I tried against the trend. Now, maybe at that time I didn't have enough skill in the data department, and I maybe wasn't combining strategy and discretion the same way I do now, but I just found it hard to find against the trend points intraday. I find it much easier to do that on swing trades. So yeah, pure with the trend, 5-minute pullbacks, very, very simple. But the 60-minute momentum was the key for me. That was my filter. And it meant I missed out sometimes on pullbacks that happened early, but it meant I felt good about the trade when I took it. All right. And that was partly that I used that filtering on my day trading because I was trading multiple markets, rather than if I was trading one market, I might not use 60-minute momentum. If I was to go back now, I might look at it doing it a slightly different way. So I would probably more likely to focus on one market like Kerry does. But Martin, in one of our day trading rooms, he looks for these criteria, and we'll be looking across filtering 12 markets early in the morning for that. All right. Good. So next question. This is from Abraham. What makes TSV strategies different and more reliable than others in this business? Interesting question. So I would say in terms of technicals, there's not a lot different. I think people think that there's some sort of secret sauce in what we do, but really you're either trading momentum pullbacks, momentum breakouts, you're trading reversals, you're trading reversal breakouts, you're trading mechanical setups, breaking of highs and lows. There's only so many different things. I would say what we do, Abraham, is we keep things very simple. So we don't have tons and tons of indicators. We may be using moving averages. We might add in something like MACD if it can optimize the data, but we keep the strategies very simple. I would say the other thing that we do that's key is that we will make sure that we only trade and test strategies relative to the condition. So we essentially have 3 conditions that we work to, and these are overall market conditions. And anybody on the Kickstart, you'll be spending week 2 learning this. So if you want to learn this with us, get on our next Kickstart, because this is one of the key things. And one of our room traders, David, who is about to go full time, he said that for him, this was the big difference, was only trading specific strategies at certain market conditions. So I say that's probably the first thing that we do that a lot of others don't. We don't just simply blindly trade pullbacks wherever they are. If we're going to trade with the trend, that has to be in with the trend conditions. All right. So that's probably the first thing. And I would say the absolute key second thing is the amount of data that we have behind what we do. So we will have a huge amount of data behind what it is that we're trading. We won't simply just trade something because it looked good for a little bit of time. We will make sure there's a lot of data behind what we do. And lastly, you will see us trade it. You'll see my account for FDOM. I've got 6 figures behind that. My swing trading account currently, one of them has 5, one of them has nearly 6. So there's plenty of money where our mouth is. The same with Kerry, same with Martin. So the great thing for you is if you're learning alongside us, when we win, you win. When we lose and go through that, you see us go through it and you can experience as well. So I would say they're the 3 things: market conditions, the amount of data that we have on the strategies that we trade, both back tested and live. We're ruthless about that. And then lastly, it would be the fact that we're putting our money with you and where our mouth is in terms of what we do on that. All right. How do you know your back testing is legitimate, Christoph? Now, I don't know if you're asking, how do we know ours is? Or whether you're asking, how do you know when you're doing testing? So I'll answer the first one. How do we know? Well, as a community, especially in our trading rooms, is a lot of the time what will happen is if a student's done back testing, I will look at it and check it. If Kerry and I are working on something together, then we'll check each other's. We'll take random data samples from different years and check that. Now, that's not completely foolproof, but we will check each other's data. And then lastly, we will, and this is really the good mechanism, is that whatever backtesting data you've got, you assume at least 20 to 30% worse than the figures you're getting. So if you were getting 100% return over a year, I would assume 70% over a year and a half. So I would essentially increase the time, decrease the profit. So I, by default, never look at what I've got on paper that way. And I was actually replying to a message to one of our Kickstarters from January, Matt, and I was saying this in his example is you want to make sure that you look at whatever you've got in front of you, take a big picture view, but also look at where the worst case scenario is. So take a big picture view, take some of the data off and look at worst case scenario. So if you're asking the question to yourself, how do I know your back testing is legitimate? You don't. So the only thing I would suggest is if you know somebody that back tests and they're good at it and they understand what you're doing, get them to do a data check. So get them, if you've got 100 tests, get them to take 20 at random and check the validity of them. Get somebody else to look over it, but only get somebody that understands what you're doing and understands the process you're going. If you're with us and you're working with us in our trading room, then that can happen. That could be me, that could be Kerry, that could be Martin, it could be multiple people within that process that do that. As I've said, you don't assume your back testing is legitimate. So take a percentage off and increase the time for the scenario. And then lastly, this isn't really part of your question, but I think this is really important. And it's something I've been talking about in the room in a lot of detail, but I want to just show you this. I'm just going to back the chart back up because I think this will be really useful. So one of the things that I say to my guys is this: there's 2 factors that whenever you've got your testing results, assume that you've biased it, they're biased, assume that there's a bias to what you've done. So they're probably better than they actually will be. And then 2 things that most traders don't do. Traders will look at something like the return and say, flipping out, this looks good. It's got 100% return in a year. But then they will automatically expect every month to deliver 5, 6, 7%. Well, what they don't tend to do is look at the averages. And also what they don't do is look at the worst performing periods. So there's 2 key phrases to look at. Longest losing run. So what's the longest losing run? If the longest losing run is 4, then assume you're going to hit 6. If the longest losing run is 6, assume you're going to hit 8. And then worst performing period. Now the worst performing period can include winners, but work out what the worst performing period is. And if there's 2 months that is, I don't know, a 2-month period, you were unprofitable and you ended up at one point during that month down those 2 months down -4. And by the end of those 2 months, you were down -2, then assume a little bit worse, -6, -4. And what that does is that prepares you for what we call the price you'll have to pay to deliver that 100%. So this is something I work on with all my traders in the trading room, is I say, isn't it great that we can run a trailing stop on oil? But how many more losers or break-even trades are we going to have to turn an 800% return in 16 years to a 4,000? Because there's nearly always going to be a price that you have to pay. So I hope that helps, Christoph. So just assume that there is an element of illegitimateness to your backtesting. There's going to be bias, and you're probably going to have more winning trades than the reality. Two reasons. One, skill, because trading real time versus backtesting is harder to do. And secondly, when you're backtesting, there's a tendency for you to seek out the trades that prove what it is you're looking for and sometimes miss the losers. I often get my guys, once they finish their backtesting, to go away, take a break from it, and then go away and force themselves to try and find more losers. All right. Good. So that is the questions. I'm going to come to the comments because I can see a few comments have come in there. So we've got a few questions here. When you hit a losing streak, so this question here, are there times where you completely stop trading and take a break, or do you rely on your data? The only time I would is if for any reason I hit a really, really extreme losing run that was at least 100% more than the worst losing run that I've got on, and it would at least have to hit, based on the worst performing period, it would have to hit probably a 30% drawdown, like a cut-off point. But other than that, no, I would pretty much trade through it, as I need to give it enough time, especially as a swing trader. I need to give it enough time to see whether I can come back round, which every time I've had a drawdown, that's what happens. Barry, your outcomes based on time available. Yep, we've answered that one. Another one here. How do you decide how much of your funds are allocated to trading versus putting up in long-term investments? For me personally, I base it around my goals and my skill set. So I will have a large percentage of my money in trading. So essentially, I've got two scenarios that I trade. I trade I'll beat the banks, and I will have probably, let's say, 30% of my capital there. Give or take, I probably have about 30% in my swing trading. And then I may allocate of the rest of that 30, I may allocate 20 of that to longer term investments. I'm probably inclined to probably go a little bit more like that, probably 40, 30, something like that. So 40, yeah, 70, 30 like that. I do keep a little bit of cash back, but majority of what I would be doing would be here in terms of cash. So the percentage would be highest there, probably 30, maybe 35 there. It fluctuates a little bit, but in terms of percentages, the least would be in long-term investments, because that's not my skill set. I look at our beat the bank strategy and I sit there and go, it can average 20% a year. It's likely, if it carries on the way it has, it could do a lot better. That is a tax-free mechanism if you're based in the UK, and I can get my cash out at any time. And I'm only ever 2% in the market, and I can only lose a maximum of 4 in any 1 month. So for me, I like the ability and the freedom to be able to liquidate and move money at any point. What I don't really want is my money tied up in stock. But that's because I've got a couple of mechanisms where I can grow significant returns. So for me, that is a much smaller pot. Does that make sense? So again, it comes down to your goals. What is it you want to achieve? Challenge at the moment is everybody's asking me about Bitcoin and Tesla because they've seen the price go up. But what they should be asking is, well, what do they want to achieve? And if they want to invest long term and they don't want to trade, what's their plan? So for me, my longer term investments have a very structured, what we would call very structured buy-in plan. So I will be buying in on regular slots because I've got a 10 to 15, almost 20-year plan based on the companies that I'm investing in, on the cryptos that I'm investing in. I'm not looking to withdraw cash from them. I'm not looking to make cash like I am over here. Whereas these will probably beat the banks as a 10-year plan. This has a 3 to 5 year plan. So I would say that's probably 15 actually. So that's 3 to 5 year. So that's very relative to me. For you, you need to think about what is your goal rather than where can I make the most money, and then fit the strategies in around to do that. Does that make sense? That's what's going to get you to where you want to be, rather than chasing money and chasing markets. Where do you want to be? And then you look at the timeline of those investments relative to your goals and make it all fit. So it's almost like a game of strategy. You've got to work it all out. And then you've got to allow for some flux. Sometimes you'll do better. Sometimes you'll do worse. like that Bitcoin trade, I was imagining taking half of that out in 3 years' time. I've taken half of that position in 3 months. I don't care. Lowest win rate. It depends on, personally for me, I would take probably about 40, maybe a 35. I personally don't, because I can manage the emotion of it. And I've been doing it for so long. Don't see a lot of difference between 35 and 50. Because if you spread it out over a long enough period, there is a difference. You might have more long losing runs. You might have more worse performing periods. You're going to have more losers. But for me, if I'm sitting around 35 to 45, trade by trade, I don't notice a massive difference, because in my mind, I'm thinking 100 trade data samples, whether it's back testing or live. So win-loss wise, I think if you're starting out, you should be aiming for around 50-50, because it's a lot harder when you're starting out to deal with the losses. Learning to deal with losses is the number one thing that will make you a successful trader. And that's a little bit like training your muscles. You get better at dealing with losses the longer you've been doing it. And the more data you've got, this is why our traders do so well. It's not because initially they're really good at dealing with losses. It's because they've got access to 20 years worth of data on one strategy and 5 years worth of live data on another. So they're able to see that. So part of building the kind of mental muscle to lose is having an external influences, i.e. the data, rather than the drama. And then over here, what you've got is you build the muscle through trading it and getting feedback from us. Lower win rate is potentially harder for you to maintain. Yeah, potentially, but you build the muscle. So I would work to around the 50%. As long as your expectations aren't in the 80 or 90, this is where too many traders can go wrong. It's a bit like Kerry at the moment. She's trading this new strategy live, and she's at that 70, 80% in terms of win-loss ratio. She knows that won't last because the data says something different. So she's just going through a sweet spot, and that's what strategies will do. So you have to bear in mind random distribution. So 50-50 isn't win-loss, 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 or loss-loss, win, win-win-loss. You can have periods over 100 trades where a 50-50 win-loss is much more significant. Good. Guys, fire any questions you've got. We've got 8 minutes left. So fire any questions you want me to deal with, or at least answer. I'll do my best to answer and deal with. Anybody got anything they want to go through? Any questions? Here we go, Aaron. How successful would you say your 5-minute pullback strategy was when using 60-minute momentum? It was probably about 45%, probably a 45% win-loss. In terms of return, I was doing over 100% in a year on that, Aaron, well over 100%. But what I would find is, based on the way the markets were back then, is you would get good morning runs or good afternoon runs. So you might have a couple of losers, and then you'd have one winner, but the winner would outstrip from a risk to reward point of view 5-1. Make sense? So that would probably be the key. Next kickstart is July. We're full now, David. Oh, I'll speak to Sarah. She takes care of that. But I'm pretty much think we are full. I will find out for you and let you know. So we shut it down, but I'll let you know. Yeah. So for me, just coming back to your point there, Aaron, a lot of the time what you'd get, the market would go, something like the pound dollar would go quiet, and then it might do that, and then it might do that. And then what I'd have is I'd end up having a couple of losers because price would just consolidate. And then when it went, it would eventually go. Make sense? So I might have, it might look on paper, 2 losers, 2 winners, but I was able to get a 3-1 and a 3-1 out of the trade. Yeah, that's fine. If you're on TradingView and you're happy with your broker, that's fine, Aaron. Yeah. Does that make sense in terms of visually what I'm saying there? So you price would sometimes pull back and then roll over. So you had to stick at it. Make sense? And this is why managing your risk is so important. So managing your risk becomes so important, because if you start risking too much, or you blink and sometimes the market's gone and then you've missed it. You see that a bit more on the DAX. I think that's why Kerry trades the DAX rather than currencies, because the DAX will tend to have days where it runs a little bit more. You don't see this quite as much with the currencies, but take what I'm saying there with a pinch of salt, because I'm not as active on the 5-minute charts like I used to be. So Barry, obviously complete beginner, thinking about trying to juggle trading and still doing your current job. How much do you think of it I will have to set aside each morning, or does it depend? Depends what you do. Depends whether you choose to day trade or whether you choose to swing trade. If you were trading in Martin's trading room, then you may need an hour to set your trades up. But your day trading performance, if you're only trading for an hour window every day, is not going to be as good as Kerry's. So you have to set that expectation up. Make sense, Barry? If you're trading swing trading and you're doing that like I do, I will probably put in 35, 40 minutes in the morning and then similar in the evening. But some mornings you might only need to put 5 minutes because there's no possible trades. So if you look at the moment, and not all of these trades will come off, but if you look here, now I don't trade all of these strategies, and most of our swing traders don't. But what you'll notice, can you see that they're across the 6 swing strategies that are there? They've got at the moment, we've got a lot of possible trades. So at the moment, the guys are probably doing an hour in the morning and an hour in the evening. Most of our swing traders will be trading probably 2 or 3 out of these 6. But at the moment, you can see, look, not only have we got a lot of possible trades, there's a lot of highlighted trades as well. So you'll get periods where you'll probably have to put in a little bit more time. So you might allocate an hour in the morning, but you don't actually use it. You only use 5 minutes of it because you've only got 2 or 3 possible trades. They just need a glance and a check, nothing to do, so you don't trade them. All right. So yeah, people often say, what's the minimum amount of time? What's the maximum amount of time? It also depends on how quickly you pick things up. It also depends which strategy you start with. So yeah, you need a little bit of flex. But my argument is, if you can't find an hour in the morning and an hour in the evening, then you shouldn't be doing, and you want to swing trade, you shouldn't be doing this because you're not serious enough. It's as simple as that. If you can't set your day up to find an hour in the morning, an hour in the evening, then you should probably look at doing beat the banks. All right, good. Guys, any other questions? Anything else you need help with? We've got some great stuff lined up. I'm going to get a couple of students in very soon for an interview. So we won't just be Kerry. I'll get Martin in as well, but we'll get some of the students in. I want to get Martin because I want you to hear his story, because he's got a fabulous story in terms of how his journey into trading and what he did. So we're going to get Martin in as well. We're going to get some of the students. I'm going to get some guys from outside. I've got a good friend of mine who's very, very good at helping people save money and plan out their money. A lot of people that come to TSC want to make money, but actually they could do a lot in terms of saving money and doing that. So lots going to be coming up. All right, guys, I'm going to call it a day. Thanks for your time again. I hope you found it valuable. I'll be back again in 2 weeks. We'll let you know on email what we're covering, and I'll catch up with you soon. Cheers, everyone. Take care.